What's going on, guys? Grab a pen and jot this down. Today we're going to talk about what the United Nations had asked that monetary policies that different countries do, specifically the United States, the Federal Reserve. It's a large concern for these countries that if the United States and the US dollar begins to trade in the inverse of what other currencies are doing, what's happening is the United Nations is trying to pressure the Federal Reserve to reduce rates, primarily because they're afraid of stagflation and a recession. They can't control what's happening outside of the United States, the contagion that's spilling over into other countries. The primary reason for this is because monetary policies are not the same across countries, and people don't realize this when you have currency risk, and that's why each country has its own currency. The United States is the dollar, Canadian dollar, Britain has the pound, and the real problem that we see this happening primarily in Europe, because European countries, each country have its own fiscal policy, but they have one monetary policy that's attached to the euro. And what happens is that countries don't do well, like in Italy or Greece, hurt countries that do very well, like France or Germany, or have stronger fundamentals. So when we had the last recession in 2008, and those countries were failing, it was a lopsided economic policy specifically related to monetary policy, so they couldn't figure out what to do, and they were basically straining the entire system, and right now they're straining the euro. So last week, the biggest thing that happened was that the British government decided to start the quantitative easing again. They're going to buy bonds, and they're going to again provide government intervention to fix the pricing curve in their favor. They want to interfere with public markets, and this is disrupting all the other capital markets that trade with Britain, which is the reason why it's so important to think about how currencies interact and what the trade is between global countries. So like if I'm doing business in Britain and I'm from the United States, I'm in New York right now, so I have a huge advantage because the United States, you can look at on the currency graphs, the value of the dollar has appreciated in comparison to most European currencies, and specifically the British pound. So we've become more valuable in global trade, and as we should be, because each country should focus on independent government policies. So we don't want the United Nations to tell us what to do. They should not be telling any country what to do on monetary policy. Every country has to fend for itself, and that creates global trade. Now, these countries have poor fiscal policies, they have poor government and political initiatives. That's on them, and it's not great, and it really exposes their flaws and their problems, which is what's happening right now. So these governments are trying to intervene. They're trying to make these markets. It's really hurting a lot of retail institutional investors that you can't compete against somebody who does a $100 billion bond buying program and then continues to fund it with debt, interest-free debt. So it's a weird balance of how we're doing this global trade at the moment. You can now begin to see how governments are interacting with each other, how counterparties are trading off, how currencies are valued. Whether, if you're in Britain, you're not in a good position because it became more expensive to buy things from overseas. If you're from the US, you became in a better position compared to other countries, but not necessarily a stronger dollar in terms of independence, meaning like we still have a lot of debt, our deficit's growing. And I don't know how we're going to handle our interest rate yet, but I have a strong feeling that we're going to have to reduce interest rates again in 6 months, because we simply don't have the buying power or the flexibility, I should say, to keep increasing our deficit and then increase our interest rate expense at the same time. So you got to give up one of them. You got to either figure out how to reduce the debt load, or you got to keep your interest payments really low so it's not a large portion of annual spend for the government, because at this point it's becoming so large. It's a significant interest expense is so significant that it's like equivalent to like Medicaid and Medicare spending. So you got these social security programs, you got these public programs funded by the government. You're paying more in interest expense than you are for programs that will help and benefit other people. So it's catch-22. I don't know how this is going to play out, but I think there's going to have to be some middle ground that's being met between the United States, between its counterparties, so in Europe and other nations, and the United Nations as well.